There are so many things to cover, it's hard to know where to start, but let's go through a few of them and how you would be looking at it if you were sitting in one of those policymaking positions that you've had in the past. First of all, at the very end of the week on Friday, we had SVB Financial, that's the parent company of Silicon Valley Bank, declare bankruptcy here in New York City, and the bonds, as I understand, initially actually went up. What do you make of that?
Bankruptcy seems like the right thing for a company that's insolvent and the government is resolving it. Worried me to see those bonds go up. I don't understand why whatever money is going to the bondholders that the bondholders are looking at isn't instead being committed to defray the government's liability for depositors. I hope somebody's looked carefully at all the executive compensation arrangements and that any deferred compensation has been wiped out for SVB executives, whether it's coming from the bank or it's coming from the holding company, wherever it's coming out. That was the president's clear commitment, and I'd be a little concerned based on what I'm seeing, but obviously you have to respect the rule of law, and I don't know all the legal details.
Larry, you've been concerned about contagion. A lot of people have all week long. We had the First Republic Bank situation, and then late Thursday, overnight Thursday night, we had Secretary Yellen apparently make an arrangement with Jamie Dimon of JP Morgan for an infusion of $30 billion in deposits into the bank. What do you think about that?
Well, it was JP Morgan and a number of other banks who were apparently corralled by the secretary and by JP Morgan. I don't know what to make of it. The government has committed to put money in there at par, above the market value of securities for a year. The fact that the banks made a commitment for 120 days so they can get out well ahead of the government at an interest rate that we don't yet know what it is, with what the understandings in the agreement with the Treasury are. I suppose the fact that everybody's acting will make people a little more confident, but it made me nervous. This was not an objective private sector assessment to have confidence in First Republic. So I'm not sure what to make of it. It seemed a little corporatist and deal-based between the government and big banks to me, but we'll have to see how it unfolds, and I hope there'll be total transparency on all the understandings.
What does all this mean for the central banks, particularly the Federal Reserve, as we look toward a decision next week, coming on the heels of the ECB, and when you saw what Madame Lagarde did this week?
I think Madame Lagarde was terrific. She did three very important things. She showed that you can carry through on necessary anti-inflation monetary policy even when there are financial strains. She made very clear that with two different problems, inflation and financial stability, you can use two different instruments to respond to those problems and not sacrifice on the inflation dimension. And she ended forward guidance. And I hope in many ways that will be a role model for the Fed. Forward guidance has mostly, since rates got off the zero floor, been an unfortunate muddle. I think we can use policy directed at standing behind depositors separately from monetary policy. And I think it's appropriate, at least on current facts, and they're changing very quickly these days, but on current facts, to raise rates by 25 basis points. So that's where I would be coming down. I do think that the Fed should not allow financial dominance, but does, of course, need to recognize that slower credit is going to be the result of that and assess it into its macroeconomic forecast. But as I read the economic evidence, the slowing of credit is not nearly as much as the amount that the Fed has that the market has taken out of its expectations of how the Fed is going to tighten. So I hope the Fed can move forward 25 basis points.
So, Larry, I understand your point, I think, about market dominance. We don't want to have that. At the same time, is it exactly right to believe, as Madame Lagarde does, that in fact using one of those policy instruments does not affect the other? And what I'm talking about is price stability and financial stability. Didn't we not see this week perhaps some evidence that when you go after price stability, you actually can affect financial stability?
You can. The way to deal with that is to adjust the other policy instrument by standing behind the affected institution. If I lose weight, it affects how well my clothes fit, but that's not an argument against losing weight. It's an argument for going to the tailor. And that's the same principle as using policy instruments to respond to financial concerns. I think it would be very unfortunate if, out of solicitude for the banking system, the Fed were to slow down its rate of interest increase beyond what was appropriate given the credit contraction. It would raise inflation expectations on the one hand, and I suspect many people would feel that if the Fed was scared, they should be as well. And so, ironically, it could both raise inflation expectations and contract the economy.
Larry, what did this week mean for financial regulation? And I guess I'm asking two questions. How well we're doing it, because there are a lot of people really questioning, particularly the San Francisco Fed and its regulation, its oversight of Silicon Valley Bank. But number two, our confidence in the regulators. You saw the report that, reportedly at least, Chair Powell delayed the announcement about what was being done with Silicon Valley Bank because he wanted to take out any reference to problems with regulatory authorities.
Look, it's a mistake to rush to judgment when you don't know all the facts. But it sure looks like this was an egregious failure of supervision. We had hugely rapid growth in deposits. We had a obvious mismatch in duration. And it sure doesn't look like the supervisors at the San Francisco Fed were on top of the situation. Again, we don't know everything yet, but clearly this needs to be a cause for some soul searching within the Federal Reserve System. We have to be careful, David. The central irony of financial crisis is that it's caused by excessive lending and it's resolved by more lending. And so we need to be careful in the very short run, throwing the book at all the regional banks, because that may exacerbate a credit crunch that we don't want to have. For the longer term, I think we need to think very carefully about whether we want to have this idea of market discipline from depositors. Should a $5 million startup be in the position of trying to evaluate the creditworthiness of a bank where it just wants to hold cash so that it can meet its payroll? I think the answer to that question is no. And so I hope we move to, over time, a financial system in which basic cash deposits sit in Treasury bills or sit in institutions that intermediate them into Treasury bills, and we separate the risk-taking function more securely than we do right now from the liquidity provision function. But that's for the long run. It's going to take a huge amount of thought, but there are very profound conceptual questions raised here. But right now, it's looking to me like the idea of market discipline from depositors just isn't a very strong idea.